Greetings, finance enthusiasts, and welcome to the House Lux Estate channel. We're your go-to source for practical advice on all things finance. Today we're tackling a topic that's on everyone's mind, reducing debt. But here's the kicker. We're not just talking about any debt reduction. We're focusing on how to do it without affecting your credit score. Yes, you heard it right. So buckle up and let's dive into the world of smart finance and learn how to reduce debt without damaging your credit. First off, it's crucial to understand what we mean by debt and credit score. In the simplest terms, debt refers to an amount of money borrowed by one party from another. It's a financial obligation to pay back the borrowed amount, usually with interest. This could be anything from a credit card balance, student loan, car loan, or a mortgage. Now let's talk about credit scores. A credit score is a 3-digit number that lenders use to evaluate how likely you are to repay borrowed money. It's based on your credit history, which includes your borrowing, repaying, and outstanding debts. Credit scores range from 300 to 850, with 850 being the best score possible. The better your credit score, the more likely you are to be approved for loans and receive favorable interest rates. Why is a good credit score important, you ask? Well, a good credit score can make your financial life a lot easier. It can open doors to better loan and credit card offers, lower interest rates, and more negotiating power. It can also influence how much you pay for insurance and even your ability to rent an apartment or get certain jobs. However, if you're facing a mountain of debt, it's easy to feel overwhelmed and see your credit score take a hit. Too much debt can lower your credit score, making it harder to get approved for new credit and leading to higher interest rates when you do. It's a vicious cycle that can be difficult to break free from. But here's the good news. You can reduce your debt and maintain a good credit score. It's all about understanding your financial situation and making smart decisions. It's about knowing how much money you owe, to whom, and at what interest rate. And it's about developing a plan to pay off that debt in a way that doesn't hurt your credit score. Now that we've got the basics down, we can discuss how to reduce debt without hurting your credit. Step 1 in reducing your debt is budgeting. Have you ever wondered how you can gain control of your finances? Well, the answer is simple. Budgeting. It's a fundamental tool that can transform your financial life, paving the way for a debt-free future. But what exactly is budgeting? In its simplest form, budgeting is all about understanding and managing your income and expenses. It's a financial roadmap that guides you on your spending, ensuring that you live within your means and allocate funds to important areas of your life, including debt repayment. Creating a budget might seem daunting, but it's not rocket science. To start, you need to have a clear picture of your monthly income and expenses. This includes everything from your salary to your daily cup of coffee. Once you've got that down, it's time to categorize your expenses. Fixed expenses like your rent or mortgage are non-negotiable. But variable expenses, such as entertainment or dining out, are where you can make some cuts. Now, here's where budgeting becomes a game changer in reducing your debt. By trimming down unnecessary expenses, you free up more money to pay off your debts. It's like finding hidden treasure in your own pocket. But remember, a budget is not a one-size-fits-all tool. It should be tailored to your needs and lifestyle. If you love your morning latte, maybe you can cut back on something else instead. The key is to find a balance that works for you. Also, don't forget to include a savings category in your budget. It's crucial to build an emergency fund so that you don't have to rely on credit when unexpected expenses arise. This way, you avoid accumulating new debt while paying off the old ones. Budgeting might feel restrictive at first, but think of it as a financial GPS, steering you towards a debt-free life. It's a habit that requires practice and patience, but once you get the hang of it, you'll see its magic work. Mastering your budget is the first step towards financial freedom. So roll up your sleeves and start budgeting today. Your future self will thank you. The second step is negotiating interest rates with your creditors. Now let's dive into how interest rates can contribute to growing debt and how you can go about negotiating them. First, let's understand what an interest rate is. Simply put, it's the cost of borrowing money. It's how creditors make a profit from lending you money. Your interest rate is expressed as a percentage of the amount you owe, and this percentage is added to your debt total over time. So if your interest rate is high, your debt can grow quickly, even if you're not spending any more money. Here's where negotiation comes into play. Negotiating lower interest rates with your creditors can be a powerful tool to slow down the growth of your debt. It might sound daunting, but remember, you have the right to negotiate the terms of your debt. So, how do you go about it? Start by getting familiar with your current interest rates. Look at your credit card statements or loan documents, or call your creditors to find out. Once you know what you're currently paying, do some research. Compare your rates with those offered to new customers or with averages for your credit score range. Now you're ready to make the call. Be polite but firm. Explain your situation clearly and ask if they can reduce your interest rate. If the first person you speak to can't help, ask to speak to a supervisor. Remember, persistence can pay off. Consider this: if your request is denied, it's not the end of the road. You can try again in a few months or consider transferring your balance to a card with a lower interest rate. But be cautious. Balance transfers often come with fees, so make sure it's a financially sound decision. Negotiating your interest rates can be a bit of a balancing act. But remember, every percentage point you can shave off your interest rate is money in your pocket and less debt that you're accumulating. Negotiating lower interest rates can slow down the growth of your debt. And slowing down the growth of your debt is a significant step towards reducing it without affecting your credit score. The third step in reducing your debt is prioritizing your payments. Now, what does this mean exactly? Well, it's all about being strategic with your money and determining which debts should be paid off first. Let's say you have multiple debts. You have a car loan, a mortgage, and a couple of credit cards, each with their own interest rates. It's essential to know that not all debts are created equal. Some debts can accumulate interest faster than others, and these are the ones you want to tackle first. Paying off high-interest debts first is often referred to as the Avalanche method. Imagine a snowball rolling down a mountain, gathering speed and size as it goes. It's the same with your debt. The longer you let it roll without addressing it, the bigger it gets. That's why it's crucial to stop the highest interest debts first, preventing them from snowballing out of control. On the other hand, there's the snowball method, which involves paying off the smallest debts first, regardless of the interest rate. This method is less about math and more about motivation. Each small debt you pay off gives you a sense of accomplishment, and this can provide the momentum you need to keep going. However, the most efficient way to reduce your overall debt is usually to focus on the high-interest ones first. Remember, the faster you pay off these debts, the less you'll end up paying in interest over time. It's also worth mentioning here that while you're prioritizing payments, it's vital not to neglect your other debts. Make sure you're still making the minimum payments on all your debts to avoid late fees and potential damage to your credit score. So, to sum it up, prioritizing your payments is all about strategy. It's about knowing which debts to tackle first and being consistent with your payments. It's a step-by-step process, but with patience and determination, you can navigate your way out of debt. Prioritizing your payments can help you pay off your debts faster. Let's quickly recap what we've discussed today. We've journeyed through 3 significant steps to reduce debt without negatively impacting your credit score. Firstly, we delved into the importance of budgeting. We emphasized the necessity of knowing where your money goes every month. By creating a budget, you're able to see your income and expenditures clearly and make informed decisions about where to cut back. Next, we explored the often overlooked strategy of negotiating interest rates. Remember, credit card companies and lenders are often open to discussions about reducing interest rates. It's all about the courage to pick up the phone and ask. A lower interest rate can save you hundreds, if not thousands, over the lifespan of your debt. Lastly, we tackled the concept of prioritizing payments. We highlighted the Avalanche method and the Snowball method as viable strategies to consider. By focusing on one debt at a time, you can reduce your overall debt quicker and with less stress. Each of these steps, when implemented with consistency and discipline, can significantly lower your debt without causing damage to your credit score. Remember, it's not about quick fixes, but about a sustainable journey towards financial freedom. Remember, reducing debt without hurting your credit score is a journey. Start today, and you'll thank yourself in the future. Don't forget to like, share, and subscribe to HouseLux Estate for more financial tips. Until next time, keep your finances strong.